Hey, welcome everybody. Hope you had a great weekend and looking forward to taking you through the system performance tracker. So let's get into it. Let's not waste any time. What I want to do first up is basically take you through the concept behind the system performance tracker and give you a little bit of a refresher on the R multiple and what it is we're trying to achieve with this particular indicator. And it'll evolve into more than just an indicator. Obviously it'll evolve into central register for tracking our systems. That's where it needs to go to, but obviously we need to start with the base product or the base tool, and we're going to build that up. So this first version that you're going to get, which we're going to send out is a beta version, so it's a testing version. Remember, when I take you through this and when you look at it, the idea is that this next 5 to 7 days is all about having a look at it, testing it, working out what you want to include in it, what you want taken out of it, and giving that feedback back to us, because our goal is to then refine the indicator and the product, and then kind of move on to phase 2, which I'll go to in a second. But the first thing I want to do is just set the scene for everybody. Now I want to do a bit of a refresher just quickly on the R multiple. Now, some of you may not have gone through the money management modules yet, and some of you have. Now, what we're looking for in relation to our R multiple is that's measuring our level of risk. So each system that we trade has, as you know, a specified stop, or a hard stop if you want to call it that, and that's basically a precursor to trading the strategies that we've got. We always have to have an initial stop in there. So that initial stop is what we call our R multiple. Now that's our measurement of risk. So we're prepared to, when we go into a trade, take a certain amount of risk that we've predefined as basically our level of risk that we're going to accept in the market. Now with this example here, I want to show you I've got basically some details of a crude system here. It's got an initial stop of 16 points. So it means that when we first take the trade, we're prepared to risk $160. So the way we would represent that as an R multiple would be -1R, because when you talk about R, you can have positive and negative. Positive 1R means that you've made $160, and negative 1R means that you've obviously been stopped out and you've risked $160, or you've had your maximum loss taken. Is everybody fairly clear with the R is equal to risk, but it also represents the reward on the trade as well? So if our initial risk is represented as 1R, then we've got to give that a value, and the value we've given this particular example is we've said 1R is equal to $160 or 16 points, because in this market, crude oil, 16 points represents $10 per point, which is $160. So we're saying that 1R is equal to -1R is equal to $160, positive 1R is equal to $160, a -2R would be $320, or a positive 2R would be $320, I should say. So for example, if we had now remember, we're working in values of R, which is basically 160. So if we have a 9 times our risk is -1440. So what we've said here is that our maximum drawdown on this system is $1,500. So we might use, that's our worst ever drawdown, is $1,500. So let's assume that our average drawdown runs at just around, our average drawdown is $1,200 and our maximum drawdown is $1,500. So where we'd want to sit our R breaker or our circuit breaker, because this all relates to when we're going to turn this system off, and this is why we've developed this indicator up, because we want to know, as traders, we want to have an objective measure of when to turn our system off. We don't want to blindly trade and then, you know, hopefully the system runs well and we can come out of a drawdown. Well, we don't want to experience a sustained drawdown. We want to have an objective strategy that says, right, well, if historically your maximum drawdown is $1,500, that's your worst drawdown, Obviously, we definitely want to be out before we around that $1,500 mark. We don't want to be holding on after that, because it's historical drawdown. But if our average drawdown is $1,200, we might sit our circuit breaker in at, say, $1,300. So we're just below the average drawdown, sitting between the average and the maximum. Because the other thing too is, if our maximum drawdown was say $3,000, but our average drawdown was $1,200, we would definitely want to get out of this, or turn this system off around about $1,300, because we wouldn't want to give up $3,000 on a drawdown because we want to keep because we've had one really bad drawdown. We want to kind of sit it just below our average drawdown. So that's something that you need to decide on personally yourself. You need to work out, when you're looking at your equity graph, you're looking at your system performance, you're looking at your drawdown, you need to work out where you can potentially put your circuit breaker, because it's all about preventing that fairly severe drawdown. And we're seeing with some of the markets that we trade that systems can have serious drawdown. We saw from the DAX data that we've tested in the money management program that system had almost 60% drawdown. Now that's a fairly substantial drawdown, and we know psychologically it's hard to manage that process when you're trading and trying to trade through a sustained drawdown. And what you'll find is, when you have a circuit breaker in place, that definitely makes a huge difference to your performance and your trade psychology. So that's what we want. So just a bit of a recap here. So we always want to have identify what our maximum drawdown is, and identify what our average drawdown is, and we also want to find a happy medium of where we're happy to turn the system off and be objective about that. Now, a couple of things to remember here is that when you're trading a system, there will be a point at which the system obviously hits your max drawdown and you're waiting for it to come back in. And this is one thing that I need to explain here, because the strategy that we've set up has what we call a bounce option. So what is a bounce option? Basically what it means is that your system's trading along, it might hit an equity high of, say, $5,000. It then goes into a drawdown of, say, $1,200, and that's where we turn it off. So we've said, right, well, we're turning this system off at $1,200 because we don't want to trade, irrespective of the drawdown. We want to have a definitive circuit breaker. So we've turned it off at $1,200. That means that we're waiting for it then to bounce back, so it to improve its performance. And we know that, based on our experience, that systems bounce back. We've seen it on the DAX, crude, all of the markets we've traded. We've seen definitely a bounce option to come into play. There's probably only one or two systems where I haven't seen that happen, but typically they will bounce back. So what you're looking for is, you're looking for the lowest equity point, or the maximum drawdown, and a bounce off that max drawdown. Now again, you need to determine what that bounce value is. So how much money, or how many multiples of R. So if your risk is $160, are you looking for a 3R from your lowest point to get back in? Are you looking for 4, 5R? How many full winning trades do you need to get back into this system? So that's something you need to work. Basically, we've got people going with, say, a positive 6R. So you might have, say, instead of waiting for the system to get back way up here, say it has a drawdown of say $3,500 or $4,000. Instead of waiting for it to make up that and get back above that $1,200 drawdown, you're getting back in here from a bounce, say, of $1,000. So you might say, well, if it's had a maximum drawdown of $5,000, if it makes up $1,000, so if it recovers $1,000 of that $5,000 drawdown, I'm back in. It might be, you might decide, well, you only need $600 bounce off that lowest point and you're back in. So you have to set the parameters for that get back in point, that turning the system back on. Because what you don't want to experience is, you don't want to see a system have a massive drawdown of, say, $5, $6, $7, $8,000 or whatever the value is, and then trade all the way back up to where you turned it off and then get back in. And you potentially may have missed $6,000 or $7,000, and we've spoken about this a couple of weeks ago in the room, that Jim's identified this on the DAX, where the DAX has had a drawdown of, say, $8,000, and then at a point it's got back in and started trading profitably and made up that $8,000 plus another $8,000. So if you had have gone back in at your circuit breaker level, then you've waited for it to actually make up $8,000 worth of profit, where you could have got in at a lot lower level. So this is what we call a dynamic entry. So we don't just have an equity high and then fix our circuit breaker here at $1,200 from our equity high and just wait for it to get back up there. We actually work it off the lowest point of our equity, so of our drawdown, and we look for the system to turn around and start being profitable again. So what I want to make sure is that when I'm setting this up, think about it this way: you've got to have a circuit breaker for your system, so you've got to determine what your circuit breaker is, and then you want a point at which you get back in on the trade. And we're going to go through and have a look at some equity graphs here in a second, and look more at